Mukesh Sadev, Global Head of Commodities Markets Oil at Rystad Energy, and soon to join us, hopefully, Robin Mills, CEO of Qamar Energy. Maliha, let me start with you. We haven't had you on for, I'd say, a month or so, and so much has happened to these favorite markets of yours. So give us your take on where we're at today. I mean, we've, the last 2 weeks of extreme volatility on bonds and stocks, etc. Where we're heading, are we beginning to see a recovery, dare I ask?
Thank you, Diala. It's good to be on. There's a lot happening every single day. I feel like we've only been to 2 years. The main thing is all about the dollar and Trump's policies. I think the market has been very confused about what has been Trump's agenda. So there are two schools of thought. I actually spoke about it about a week and a half ago. There's a note that I wrote, "The genius behind the madness," because I think what Trump and Scott Bessent are doing are clearly in line with what they've always said. They need to get lower oil prices, lower dollar, and they need to get US jobs back onshore. It's the execution that is obviously a bit concerning, but his path is, he's doing exactly what he wanted to do. The US needs to get interest rates down. They need to refinance about $9 trillion of their debt. They need a lower dollar, but a lower dollar cannot happen until we get a slowdown or some sort of a recession, which is what he's doing. Like I said, so there are two things happening in the market right now. Trump's tariffs are very concerning because obviously the market does not understand where he is going to, but this is all about leveling the playing field. It's not about, causing a depression or anything. He's just trying to get the money because US has been charged like 2.5% tariffs, but they pay about 10 to 15% on average. So they want the world to pay them back for what they've been doing because the US itself is getting broke right now. So there's a lot of stuff happening, but taking a step back on the volatility, Diala, it's all about positioning. You have a lot of levered funds right now trading in 3 or 4 times ETF that are causing these massive swings up and down because the market in the last 2 years has changed with the zero DTE options. So let's talk about the fundamentals, but positioning is what got the market down. And now we are running because people are very short. So I can get into some specifics right now, but it's all to do with positioning. But the bigger picture of Trump has not changed. It's quite clear what he needs and what he's trying to get for the US economy.
Okay, thanks, Maliha. Well, so Trump is proceeding as he's planned, and he's getting lower dollar value. He's getting lower oil prices. Mukesh, let's go to that. I mean, we've seen oil prices obviously fall in line with the dollar, which is not the usual way of things. But of course, that's on the back of, demand outlook. I mean, we just saw the IMF downgrade the US GDP forecast for the year by a whole percentage point compared to just 3 months ago. And I haven't tracked what it said about other economies. But what does it tell us about where oil's going? We're already in the securely now in the low to mid 60s. Much more downside to come, do you think?
No, I think I won't say downside to come because we are typically so hooked on thinking in year-on-year growth numbers, right? Year-on-year growth numbers, everybody's minds is 2 million barrel supply, a lot from non-OPEC, some from OPEC, but demand is not growing nearly even 1 million barrels per day. If the GDP and the tariffs contraction at 2.4% GDP, our number of demand growth is only 0.6. So, you can draw a very easy conclusion that the prices should be going down, right? But I think this kind of year growth analysis works on a normal year. Trump 2025 is not a normal year. What we can talk about is maybe the next few months. And I think the next few months is about summer. So from now till the August and July peak period comes, the demand will increase, the seasonal demand. The refineries will come out hungry for crude oil, and those numbers are above 2 million barrels per day. But the OPEC and the non-OPEC supply is probably only 1.5. So we are entering a phase where the balances will be tighter, and that's reflected more in the backwardation in the curve, in the time spreads rather than the flat price. And so I would say summer is still to come, and we are already near the 68 mark. Despite all the bearish news, the oil price has not gone down to what a lot of people were talking. So I believe the fundamentals are clearly going to point towards a higher oil price from where we are now. Now, the geopolitics will, of course, keep it going in a yo-yo mode.
Yeah. Okay. Thanks, Mukesh. Robin, good morning. I mean, yes, oil hasn't had a bad start at the beginning of the year. And in terms of fundamentals, people were starting to talk about more tightness. and more about demand rather than oversupply, as the mood was towards the end of last year. But we do have OPEC adding more oil at the moment and planning even more in May. But Robin, I mean, from your perspective, how healthy are the fundamentals on the oil market going into the second quarter? And can they absorb, first of all, the extra OPEC oil? And where do you see that trend heading?
Well, I think the attention is from the OPEC side that they're not able to absorb the extra oil. I think that's the intention of the move from April and May, particularly the move from May. Look, I mean, there was a discussion with the White House, and the tariffs were announced only a few hours before the OPEC decision. So I think it's pretty clear that OPEC knew well about this and had planned for it. And I see this as firstly as a move where they can give the White House something it wants. But actually, I think that they're getting what they want too, certainly from the Saudi side, which is higher production, which is a realignment of quotas, because if everybody's quotas go up a bit, but then they put the compensation cuts on Iraq and Kazakhstan, then Saudi and UAE and others are able to gain share a little bit against those who are overproducing, even if Iraq only kind of stays flat rather than actually cutting back. And they're able to put pressure on US shale. In US shale, I think they've chosen a good moment to strike because prices are lower, and costs for US shale have gone up, and also economic uncertainty has gone up considerably. So I think we'll see a much weaker year for US shale than we would have seen, and weaker even than we would have seen if prices had been at 68, let's say, for some other reason, because of the higher input costs.
And how? So if that's you're saying it was intentional, OPEC, led by Saudi, obviously, and the UAE and some other members, intended for this to happen. They're sort of adding oil into a weaker market, making up for what they've sort of held back on, and pleasing the US at the same time. How long do you think they would continue that strategy? Would we see that continue into the second half of the year in terms of affordability of having prices in the 60s?
Yeah, look, I don't think that they're in for a massive price war yet. I don't think they're in for a repeat of 2020 or the period up to 2016. No, I think they're in for a period of, they're looking for a period of somewhat weaker prices and pushing back against US shale. Maybe US shale has a year of no growth, and then OPEC is able to regain some of the market share that it's lost. I think that would be more the intention. So it'll still be case by case. It'll still be month by month on looking at the market and where prices are and whether they decide to have further increases or not. And also, of course, how are their colleagues doing on compensation and compliance? I don't know if anybody realistically expects compensation, but at least better compliance out of Iraq and Kazakhstan. I think we saw a clear warning to Kazakhstan last month from Russia to show that you guys, you really have to fall in line. You're a relatively small producer, and yet you're the proportionally the biggest overproducer. So I think that warning was pretty clear.
Yeah, and I mean, many people attribute the Kazakhstan increase in Feb, particularly to the Chevron or to one of the refineries there, etc. Perhaps it will prove to be temporary. Maliha, we talked a bit about stocks to start off with and the positioning there, but let's look a bit broader and the Fed policy and where that's going. We've seen, of course, Trump do two things the last 24 hours. Not surprising, perhaps, back off on China as they seem to be gaining the upper hand in the rhetoric on trade, and also back off on poor chairman, Fed Chairman Powell, who's, I have to say, I mean, this guy has great stamina. He's been through a lot in the last few years, even before Trump. Where do you see that pressure, do you think, holding on the Fed? He's backed off a bit, but Trump still wants, as you said, to lower interest rates, and the Fed doesn't seem to be going that way.
Diana, I think that the comments between what he's saying to Powell, you take it with a grain of salt. The Fed has a very independent structure, and I think it's more like a Netflix saga. Chairman Powell has a dual mandate. Either employment market cracks or inflation falls down. And I think he's going to stand pat till those things happen. Now, the data is showing softness because the soft data and the hard data shows a discrepancy. We are slowing down. Inflation's coming down. But the Fed does not have the capacity. We've spoken about this. They cannot look forward into the future. They play a reactionary role, not a preemptive role. So once the data shows that inflation's falling below 2%, they will cut rates. And the employment market is showing signs of weakness, but it's still holding up quite well. So end of the day, that is just business as we go along. We know that at some point, if the inflation numbers, and you can see the rhetoric on the future indicators talking about inflation probably below 1.9% right now on the CPI core measures. So it's all looking really good. But end of the day, the Fed won't lower rates just because because the market's on 10%. So let's move that aside. But in terms of China, the rhetoric, I think the market has it a bit wrong. I think Trump has more cards than China does. China's going through a massive deflationary cycle. They have an unemployment issue after COVID. The industry is in shambles. The China yuan is in shambles. They cannot print more because the yuan is going to be completely seeing capital outflows. China's factories right now are shutting down. 20% of the exports go to the US. Trump knows that. They cannot find partners overnight, and China's an export market. So end of the day, they both need a deal, but US can hold up for a lot longer than China can. So I wouldn't say that China has the cards. I think there's going to be some sort of a compromise, and that's what's happening. They both need to show face to the world. But end of the day, we can't go on like this. And you can see China's making the rounds with Mexico and Europe to try to get new partners.
Yeah.
But these alliances don't change overnight. So I won't say they're folding, but they both know that they want some sort of a leveling the playing field. So as opposed to 165 tariffs,
Yeah.
maybe 15% tariffs, which is actually the new norm. End of the day, it's all about Trump's deal-making process, right? He starts really high, goes all in and then lowers down. So I think we need to see all those headlines with a bit of salt. But the sell side assumes that we stay in this horrible scenario for 12 months, recession, depression. But if this thing is sorted out in the next few weeks, market is not in a recession mode. The data is actually quite constructive. So are we really in a recession? Are we in a depression? The market is priced in so bearishly right now. Stocks are trading on a 20% discount that I think that's where the pain trade is, in our opinion, effectively.
Okay, thanks, Maliha. Mukesh, I mean, Maliha mentioned China. Let's talk a bit about the indicators from there in terms of the demand so far this year for oil and also refined products activity, and their re-export into Asia even. There was a lot of talk about petchems, even they're slowing down a little bit, and other sort of refined products. Give us a picture there for the outlook for the rest of the second quarter for China.
Good question. And I would also comment on what Maliha was mentioning. I think if we don't go into speculation and the rhetoric and the talk, let's talk some, hard numbers. Number one, I would say the more important point is China in a check mode? And my answer is no. This is not the first time China has seen tariffs. China has seen tariffs in the first term. Biden administration was no different. The tariffs were not removed. So I would say China has been well prepared for this kind of situation, and China has the cards. That would be my contention. Now, why do I say this? Number one, if we look at from a demand perspective, China used to grow at 500, 600 on an average, 1,000 barrels per day. China, even before the Trump came, was not growing with those numbers. The growth was maybe 180, 200. So now we are seeing GDP contraction. I mean, the first quarter was 5.4 number, which is a number which China targets at 5. And if these tariffs continue, we are looking at, from a headline angle, we will say, oh, China's demand is half. But it's half from where? It's half from a very lower base. So China is not impacted so much from a demand angle. The second point I would make is that let's not just look at demand in China because of China. China's impact on rest of the emerging economies and rest of the world on how China is supporting those initiatives, China's impact will be seen in the demand for rest of the world. And with Trump actually taking antagonizing position with a lot of those countries, China's with Vietnam and other players, I know things don't change overnight, but I would say things do change overnight when you have a shock like what we are seeing in the White House. The third point I would make is that if you look at the crude production, China is producing steadily at 5 million barrels per day. China's imports are from the nations like OPEC. Very steady relationship between Aramco, ADNOC. I was just 2 days ago in Riyadh, and Aramco is opening offices in Beijing. ADNOC is opening offices in Beijing. So China's crude imports are from OPEC. China's crudes are imported from Russia. China's crude imports are from Venezuela. Where will the US export its crudes to? It's a light sweet barrel. You can't consume effectively in your own country. So you have to push into Europe. You have to push into other countries. It's not the quality the oil refineries want. So I can go on in terms of supply, in terms of demand, in terms of trade flow data. I mean, even on the gas side, I would say China not agreeing is crashing the US gas market, propane market, ethane market. So China has the cards this time, Maliha, I would say, in terms of oil and gas numbers. yes, on a top line rhetoric basis, yes, China is probably not talking the language which Trump is talking about. And now we have seen yesterday, without China giving US a call, they're saying, "Oh yes, there is a de-escalation possible." So talks won't work this time. I think China has the cards and will hold strong.
Yeah, and of course, one of those cards is that it holds a lot of US treasuries, and it played a little part in what we saw happen about 10 days ago. Thanks, Mukesh. Robin, let's talk a bit about, well, China in a way, but China, of course, one of the suppliers of its crude is Iran, and it's continuing to take Iranian crude. We've seen some significant meetings happening between the Iranians and the US in the last week. In Oman, and of course the Saudis also going over to Iran. So give us your take on where that's going. Are we reaching, should we expect some kind of, deal, not maybe the JCPOA again, but something similar in the next couple of months? Is there an urgency around that, do you think, or it's just more rhetoric?
There is an urgency. Look, I think there's a desire for a TCPOA, if we can call it that, a Trump Comprehensive Plan of Agreement, which will probably be some rebadging of what we had before. Look, I don't think either Trump or his team are very much into the details of this. I think Trump would love to have a deal that he could put his name on and, wave around. If you look at the complexity of the deal that Obama's people negotiated, of course, it took a very long time and there were multiple stages to it. I don't think the current team has the technical knowledge and the patience and the direction from above to do that.
But many people were saying, just to interrupt you, that basically what Trump is offering is exactly what Obama's deal achieved.
Yeah, sure. That's why
if we do replicate,
if we do have a deal, that's what it'll be. It'll be as with the NAFTA renegotiations and so on. It'll be basically the previous deal, just with a new name on it. Look, the Iranians, I think, have an incentive to spin this out as long as possible. Trump is impatient for a deal, and there's this 2-month deadline. There is a danger that if we go over that deadline, if the Iranians overplay their hand, that there could be some kind of military action. So that they do have to bear that in mind. They have to bear in mind that their regional situation and their own domestic military situation is much weaker than it was a few months ago.
And do you think that's going to push the Iranians to compromise more quickly this time round?
Well, I think, look, it's difficult for the Iranians. If they could get a JCPOA style deal, well, they accepted that before, so why not again? And given they're in a weaker regional position than they were at that point, I think against that is obviously, can Trump be relied on to keep his word? Well, clearly not. But could you at least do a deal that he's happy with, and then he moves on to some other thing and forgets about you? Well, that's probably doable. And the Iranians have floated some things. They know how to play on him, I think, floated some things like US investment. Now, even if there's a deal, US investors won't be running into Tehran anytime soon. No. But just the kind of tangible prospect of that dangling out there makes it sound interesting.
Thanks, Robin. Millie, is there any geopolitical risk premium in the price at the moment? I mean, we see the Iranian talks still going on. People already saying that any risk premium has been factored into prices for months, if not a couple of years. Would you say that's playing a role at all in the price on a more dynamic basis, or that's kind of,
I think it's on the sidelines. I think the main thing driving the oil price right now is recession talks, because if you're in a recession, obviously demand kill from the tariff trade wars, copper, aluminum, China, that's more important because commodities get hit, and oil is a market that has a lot of supply. So it's not like a copper or something else that has a demand, sort of supply shortfall. Right now, the biggest thing on any cross asset class that we look at is a demand. If you believe that we're in a recession or a depression, that kills I think that's much more prevalent for the price action. But there is an issue with the oil price. I think, there's a lot of talk about why OPEC decided to sort of triple their monthly quota for May onwards. Is this in, cahoots with what Trump wants? So there's a lot, but oil, we've been saying for many, many years, there is no shortage unless you see a massive demand pickup from China, but even China's secular demand has changed. So where does you can talk about a price of $57 a barrel, 60 being a lot low because US shale is going to pull back on production because it's too uneconomical for them to produce. Then you can sort of say they're in a bit of an equilibrium, but the oil price is sort of fair valued right now. But you're right, there's no geopolitical risk as such because we don't have the same market as we did 5 or 10 years ago in terms of that risk premium per se.
Yeah, I mean, and oil is cheap relative to other things, as you said, other commodities, and in particular in comparison. Mukesh, what about Russian oil? As the general sort of oil price trend has drifted down, we've seen Russian oil now go below its price cap, and so in more demand or in more operation, let's say, allowed to function more. Where are we seeing that? We saw in a headline on our bulletin today saying India's hit record imports of Russian oil in the last year, really. It's been taking more and more. Where do you think we go with Russian oil now? In the context, perhaps, of a ceasefire, but really that's sort of still floating out there, isn't it? Nothing much is changing.
Yes, the 24 hours from Trump is probably not over yet
Yeah.
to get the deal done. Here's what I would say before even we talk of Russia. Let me just make a comment on Iran, right, and the OPEC action.
Yeah.
Iran is not where it was last time around. Iran has recovered a lot, right? The production has recovered a lot, and Iran has gained much more, I would say, in the steadiness in the oil market. So we are not talking of, if the deal gets done between US and Iran, suddenly floodgates of oil are going to come. This is not a lot of oil has already come to the market, right? So this should not be too much of a bearish news as sometimes news cycle makes it. The second point, I would say that the OPEC plus increase in May is a very calibrated, opportunistic move, because Canada is going into turnarounds, Norway goes into turnarounds. A lot of the non-OPEC supply is going into some maintenance period. So it was a perfect opportunity, and summer is ahead, and OPEC can take some experimentation and risk, and that's what they have done. Now the point on Russia, what I would say is that there are only, let's say, two scenarios. I mean, there can be many, but I'll simplify. Either Russia deal gets done and Russia gets back to Europe, right? And it's all as pre-war situation on an extreme. The other extreme scenario is there is no deal done. This just continues and the oil continues to flow into Asia. Now, the first probability of the first situation happening is almost, in my mind, very low, because Europe has become a very captive market for US energy exports, whether it is
Especially
oil, whether it
gas,
is
right?
gas, and
Yeah.
whether it is even diesel. If you remember when the Houthi and the Red Sea crisis happened, who sold the highest level of diesel to Europe? It was the US. So that's a big energy short for the US markets. Will US gift Europe to Russia? Absolutely not. So then the second scenario, where Russian barrels will continue to flow into Asia, I think the price cap and the FOB price and the freight numbers, these are well managed and calculations done on how to avoid, and it has become mature. It's not just a one-day game now. It's many years now. So Russian barrels will likely continue to flow into Asia. Yes, I would say India needs to hedge, and that's why the Indian Prime Minister is probably in Saudi Arabia, these days, trying to prepare that if any eventuality happens, and if there are more sanctions on Russia, Trump imposes, then India needs to cover its shorts. Otherwise, I think barrels will continue to flow. And if really Trump wants to target Iran, Trump wants to target Russia, Venezuela, Mexico, Canada, all at the same time, then you're looking at a higher oil price, which is also Trump doesn't want. So I would say 70s is sweet, 60s is sour. That's how I would put the oil prices would be.
Okay, thanks, Mukesh. Thanks for that. There's our survey question. Markets will continue to experience volatility, which was obviously seen a lot of in the last month, until this 90-day tariff pause, which is now a couple of weeks into that period. End of the year, we're going to see this volatility through the year, or even into next year. So the volatility, which I would guess is going to continue now. It's more about where's that volatility going to take us. Robin, of course, lower oil prices intended maybe by OPEC for the time being, but they do ultimately start to impact GCC economic revenue, don't they? With certain economies such as Saudi having a lot of ambitious projects, and of course, the price now in the 60s, way below its budget deficit target. Should we be getting nervous here, sitting in the GCC, about economic growth and where we're going? will we see a slowdown ultimately because of the oil price weakening?
Well, you know, look, the budgets are set obviously a year ahead, so a month or two of lower oil prices doesn't make a difference. Also, I think there's too much fixation on the break-even price of budgets. Countries run budget deficits all the time, and the debt levels of the GCC, Saudi being the key one here, it's not particularly high by global standards. So Saudi could run deficits for an extended period and finance them through debt. We've actually seen over the past year already a lot of reprioritization in Saudi, some projects being slowed down or restructured, and more of an effort to make projects pay their way. So all these major construction projects and ventures to try to find ways that they will generate revenues and be, at least to some extent, self-funding. So that process has clearly already been underway. Now, look, if prices collapse or stay low for an extended period, then obviously budgets will get cut back generally, and Saudi first, and the other more oil price exposed members, Bahrain, Oman, will cut back for sure, and obviously eventually so will the other GCC countries. I don't think there's any immediate cause to worry. Now, the GCC, of course, and particularly the UAE, does attract flows of oil money from elsewhere. It used to from Iran, not so much now, but from Russia and so on as well. So there is also some kind of impact on those flows, but it can to some extent compensate those with inflows from non-oil exporting countries from South Asia and so on as well. So I'm not particularly worried. I think you may indeed see a bit of a slowdown of growth and maybe a bit of government budget reprioritization. Nothing major, I think, for now, unless there's really an extended price slump. However, we do need to look at some of the neighboring countries, particularly Iraq. Iraq is much more exposed. Yeah. And if I were worried about the oil-dependent economies, I would look firstly at Iraq, which is already getting uncomfortably close to a very big budget deficit, and was even before the price fall.
Of course, and facing a lot more economic challenges than the GCC economies. Thanks, Robin. Meliha, let's wrap up with you and just talk a bit about gold, because we saw it hit a fresh high yesterday, and of course it's been up and up and up for the last year or two. But I mean, really, this year, since January, and since the whole tariff story exploded. Do you think there's much more? I mean, what's the sentiment in the market? Is that just going to continue to be the safe haven as this uncertainty, volatility continues as the year progresses?
Yeah, it depends on your view on the US economy and the global market recession or not, right? So gold has been a great trade since 2022, since the Russian attack on Ukraine, because obviously a lot of central banks in the world have been diversifying their reserves into more gold, because as they know that, gold is the only way to sort of secure their country's status. You've seen China buying a lot more gold. I think the last 2 months, we've all been bullish on gold, but the rate of change of gold has been parabolic. And I think it's gone to a point where we think in the near term it's done a bit too much. Because yes, if you believe in a slowdown in recession, gold is probably the only secure safe haven to hold. Equities are not showing enough earnings growth. Bond markets are showing recession or inflation issues, which as do you park your money in, and I think that's actually exacerbated. Now, having said that, what's the fair value of gold? We think gold can go up to maybe 3,600, 4,000, but not today. I think today it's done too much. And if you talk about why gold is rallying, you can talk about Bitcoin or silver or palladium, other commodities that had the same sort of macro beneficiary, right? We are in a cycle where dollar and global fiat currency debasement is happening. We're not in trade wars. We are in currency wars. Yeah. If you look at what's happening, the euro, the sterling, the yen, every country wants a lower currency so they can have a better export sector. So what does that mean? The global fiat currency debasement is very bullish for gold. It's very bullish for Bitcoin. So the end of the day is today gold has done too much. I think everybody's long gold right now. People are very bullish. My gardener is talking about how he's long gold. So it always tells you what that means, right? It's gone parabolic. So we like gold, but it's done too much too soon.
And these fiat currencies, do you think there'll be a turnaround going forward, or have we set a new sort of bar?
Just yesterday, the dollar actually touched the lows going back to 2011. Things are in a very sort of macro trading age. I think people need to take a look at the charts and seeing where they're coming. Dollar's down about 12% from January right now. We needed a lower dollar, but this is a bit too much now. So I think if you were to take a trader's approach, I think 97.5, 98.5 is a point where it's going to be causing a lot of pain for other countries as well, because, Japan and euro and sterling, they don't like the currency so high. So we're a bit of we would not be short dollar anymore. I think that's done a lot. So the question now is, it all depends on your view on the market, right? But you have to take a view here.
Yeah. Thank you so much for that, Meliha. Thank you, Mukesh, and thanks, Robin, for joining us today. There's the survey result, 44%. 44%, yes, my eyes are telling me. end of the year. So more volatility to come. And there we have our feature interview for the week. Very worthwhile listening into Mr. Victor Gao, giving us a very frank opinions from China on trade war and GDP and everything else. So I would really encourage you to tune into that. That's in an hour's time. Thanks so much for joining us, everyone. Have a great day ahead.
Thank you.
Bye-bye.
Thank you.